Imagine a city where tulip bulbs were worth more than houses, where a single flower could buy you a ship, a brewery, or a lifetime of luxury. This wasn't fantasy. It was Amsterdam in 1637, and at the heart of this madness stood the world's first true stock market, a revolutionary new arena where value wasn't tied to land or gold but to belief, speculation, and paper promises. And then, in the span of just a few feverish weeks, it all came crashing down. Not with a war or plague, but with silence. The silence of buyers who suddenly vanished. The silence of merchants staring at ledgers filled with numbers that no longer meant anything. The silence that follows when an entire society realizes it has been living inside a dream, and the dream has just ended. This is the story of that crash. The first of its kind, the blueprint for every financial panic that would follow for the next 4 centuries. It begins not in a grand exchange hall, but on muddy streets, in backroom deals, and in the notebooks of ordinary traders who never imagined they were inventing modern finance. Long before Wall Street, before cryptocurrency, before the dot-com bubble or the 2008 crisis, there was a Dutch East India Company, or as it was known in Dutch, the Verenigd Oostindische Company, or VOC. Founded in 1602, the VOC wasn't just a company. It was a state within a state. Granted a monopoly by the Dutch government to trade in Asia, it could wage war, negotiate treaties, establish colonies, and mint its own coins. What made it truly revolutionary was how it raised money. Instead of relying on a single wealthy patron or the state treasury, the VOC issued shares, pieces of paper that represented partial ownership in the company. These shares could be bought, sold, and traded by anyone with enough cash, from aristocrats to bakers to shipyard workers. For the first time in human history, ordinary people could invest in global enterprise and profit from its success. And so, on a cold April morning in 1602, in a modest building near Amsterdam's harbor, the world's first stock exchange quietly opened its doors. There were no flashing tickers, no suits, no Bloomberg terminals. Just men in wool coats shouting prices over the clatter of wooden clogs, trading shares on scraps of parchment. At first, it was orderly. The VOC's voyages to the Spice Islands, modern-day Indonesia, were wildly profitable. Nutmeg, cloves, and mace fetched astronomical prices in Europe, and the company's dividends soared. Investors grew rich. Confidence spread. But then, something strange happened. The market began to drift away from the VOC itself. Traders started betting not on actual shares, but on future prices, on contracts called options that gave them the right, but not the obligation, to buy or sell shares at a set date. This practice, known as windhandel or wind trade, allowed people to speculate without ever owning a single real share. Leverage entered the scene. A small deposit could control a much larger position. Debt crept in. And soon, the market wasn't reflecting the health of the company or the spice trade. It was reflecting pure expectation, euphoria, and fear of missing out. By the 1630s, the speculative fever had spilled beyond stocks and into tulips. Yes, tulips. These exotic flowers, imported from the Ottoman Empire, became status symbols among the Dutch elite. Rare varieties with streaked petals, caused by a virus, though no one knew it then, were especially coveted. A single bulb of the Semper Augustus variety could fetch 5,000 to 6,000 guilders, enough to buy a grand canal house in Amsterdam or feed a family for decades. Futures contracts for tulip bulbs exploded. People signed agreements to buy bulbs they'd never see, from gardens they'd never visit, betting that prices would keep rising forever. The system became a house of cards, built on the assumption that tomorrow would always be more valuable than today. And then winter came, literally and financially. In early February 1637, during a routine bulb auction in Haarlem, something unexpected happened. No one showed up to buy. The auctioneer waited. The crowd murmured. The bids never came. Panic spread like frost across a pond. Within days, similar scenes played out in towns across the Netherlands. Buyers disappeared. Sellers flooded the market. Prices collapsed, not gradually, but catastrophically. A bulb that sold for 2,000 guilders one week traded for the price of a crate of onions the next. The crash wasn't just about tulips, though. It exposed the fragility of the entire speculative ecosystem that had grown around the stock market. Banks that had lent against tulip contracts froze credit. Merchants who'd used paper wealth to buy real assets found themselves insolvent. Trust evaporated. The government scrambled to respond. Officials declared that buyers could void their contracts by paying a small penalty, just 3.5% of the agreed price. This was meant to soften the blow, but it backfired. It turned every contract into a potential default, destroying the market's credibility. Confidence didn't just dip, it vanished. And yet, remarkably, the Dutch Republic didn't collapse. The real economy, the shipbuilding, the textile mills, the global trade, kept humming. Why? Because the crash, for all its drama, had mostly affected speculators, not the core financial system. The VOC itself remained profitable. Its shares, though volatile, never vanished. In fact, the company would go on to dominate Asian trade for another 150 years. But the psychological impact was profound. The Dutch began to view speculation with deep suspicion. Moralists wrote pamphlets condemning greed and vanity. Artists painted satirical scenes of fools trading bulbs for rags. The phrase tulip mania entered the language, not as a celebration of innovation, but as a warning against collective delusion. Still, the genie was out of the bottle. The mechanisms invented in those Amsterdam backrooms, shares, futures, options, margin trading, would not disappear. They would spread across Europe, then the world. London Stock Exchange, founded in 1773, borrowed directly from the Dutch model. New York's Buttonwood Agreement in 1792, which birthed the New York Stock Exchange, echoed the same principles. Every bubble since, the South Sea bubble, the railway mania, the roaring 20s, the dot-com boom, the housing crisis, has followed the same emotional arc. Innovation breeds opportunity. Opportunity breeds greed. Greed breeds denial, and denial breeds collapse. What makes the 1637 crash so enduring isn't just that it was first, it's that it revealed a fundamental truth about human nature. We are wired to believe that this time is different, that the rules have changed, that the upside is infinite. And when the crash comes, we're always shocked. Not because we didn't see the signs, but because we chose to ignore them. Because believing it would mean admitting that the world isn't rational, that prices aren't always grounded in reality, and that sometimes a flower is just a flower, not a fortune. The VOC's ledger still exists today, preserved in Dutch archives. In them, you can trace the rise and fall of fortunes with cold, precise ink. But what they don't show is a human drama. The baker who sold his oven to buy tulip futures, the widow who lost her inheritance, the merchant who jumped from a canal bridge. Those stories live in letters, court records, and tavern gossip. And they remind us that behind every market number is a person making a bet on the future. Sometimes that bet pays off. Sometimes it destroys. The brilliance of the Dutch wasn't just in creating a stock market. It was in creating a system flexible enough to survive its own self-destruction. After the crash, Amsterdam didn't shut down the exchange. It refined it. It introduced clearer contract rules, better record keeping, and more transparency. It turned chaos into structure. That's the real legacy of 1637. Not the crash itself, but the recovery. The understanding that markets aren't just machines. They're living organisms, prone to fever and healing, mania and calm. Today, we trade in milliseconds, not weeks. We use algorithms instead of parchment. But the emotions haven't changed. When Bitcoin surges or meme stocks skyrocket, we're still chasing the same dream the Dutch tulip traders chased. The dream of getting rich without doing the work, of outsmarting time and risk. And when those markets crash, we still whisper the same question. How do we not see this coming? The answer is always the same. We saw it. We just didn't want to believe it. Because believing it would mean admitting that the world isn't rational, that prices aren't always grounded in reality, and that sometimes a flower is just a flower, not a fortune. The day the world's first stock market crashed wasn't the end of finance. It was its true beginning. The moment humanity learned that money is not just metal or paper, but a shared story. And like all stories, it only holds power as long as we keep believing in it. When belief fades, the story ends. And everything goes back to zero. But then, as always, someone picks up a pen, writes a new contract, and whispers, "What if?" and the cycle begins again.